and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we share with all our viewers the updates on the markets, help you understand the closing action in terms of the benchmark indices, the sectors and the stocks, what is the momentum looking like as of now, and what should be your investment strategy towards the markets as we approach the new year as well. We'll also be joined by an expert, but first up, a quick check of how the markets are doing at this point in time. Well, deep red is what you can see on both the benchmarks, the Sensex and the Nifty. 787 points, 790 points gone on the Sensex as I speak. 61,889, so that 62,000 mark has also been breached on the downside. Talk about the Nifty 50 as well. It's given up that 18,500 mark right here. 224 points of a cut is what you can see. 18,434. That's the level at which it is performing at. So it's a deep over 1%, 1.2% cut that you can see on the benchmarks. Talk about the broader markets as well. Those are also seeing some cuts, although slightly lesser than the benchmarks. 0.8% gone for the mid-cap 100 index. The small-cap 100 index also down by 0.3%. The volatility index, in fact, the India VIX levels have increased quite sharply of late. 6.3% jump, 13.7 is the kind of level that you can see over there. In fact, this kind of a sharp cut has just come in the last 15-20 minutes alone. We were seeing some cuts of about 0.7% odd throughout the trading session largely, but this last 10-15 minutes move on the downside has definitely surprised some market moves. When you talk about the sectors, well, all the sectors are deep in the red today. And led by losses in the IT sector. That's the one that's been the worst performing sector today. 2% cut for that one. Apart from this, 1.5% cut on the PSU banks as well. You can see sharp profit booking being taking place over there. The realty space is also seeing cuts of 1% odd. The auto space, FMCG basket, the metals also down by 1.4% in fact. Pharma, all of them down in trade in fact. When you see the advanced decline ratio, clearly the market breadth favors the declines at this point. 42 stocks of the Nifty 50 in the red as we speak. Which are the stocks that are actually deep in the red and are on top of the Nifty losers trajectory? When you see Tech Mahindra, that's down by 3.8% odd. Titan, Infosys, HDFC Limited, JSW Steel, all of them down by upwards of 2% to 3% as well on your screens right there. On the upside, however, there are some bright spots that you can find, from slight gains coming in on some pharma, on some FMCG majors. Britannia up by 1.5%. Hero MotoCorp, SBI Life, NTPC and HDFC Life. So the life insurance basket seeing some gains at this point despite the overall muted trend that we are looking at the markets. And then definitely if you see, this cut has come on the back of cues from the global markets and the kind of Federal Reserve rate hike that we have seen overnight as well. So the Federal Reserve continued its rate hike momentum and the battle against inflation by raising the benchmark interest rate to the highest level in 15 years. The FOMC voted to boost the overnight borrowing rate by half-odd percentage point, taking it to a targeted range between 4.25% and 4.5%. And along with the increase came an indication that the officials expect to keep the rates higher throughout the next year too, with no reductions up until 2024. Here's an excerpt from the Federal Reserve Chairman Powell's speech as well.
Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Well, that was Fed Chair Jerome Powell, and who said that the U.S. Central Bank will maintain a restrictive enough policy stance to really control inflation going forward from here too. And time now to welcome our guest for the day. Anu Jain joins us. She's the president at 360 ONE. Welcome, Anu, and thank you so much for taking the time out on this show. I first want to, take your comments on how are you really reading the market reaction that we've seen across the globe post the Fed rate hike, and also what do you make of the hawkish commentary from Jerome Powell? Anu? Yeah, I wanted to understand from you your own take on the US Federal Reserve's rate hike, the hawkish commentary, and thereafter the way that we have seen global markets and Indian markets' reaction to that.
Well, people were expecting a 50 bips hike to happen, so that was not the surprise. The fact that his undertone was still bearish and there was no kind of softness in the approach in which he approached, I think that was where the markets kind of reacted all over the world. Personally, I don't think markets are reacting to that. It's more of a situation where we were at a 52-week high, almost on the Nifty, and the Bank Nifty was making new highs. We had overstretched ourselves, so a healthy correction is welcome at this point. So while the world is correcting because of that, I think our own correction is very internal, and also that it's a Thursday today and a weekly expiry. So all things put together, I think ours is more internal and technical rather than go along with the world markets.
Right, but Anu, looking at the screen right now, it's getting scarier by the minute. 900 points gone on the Sensex right here. We're seeing 18,400 on the Nifty right now, and it could be breached any second as we speak too. 259 points gone there. Can we see a sharper sell-off in all the global equities, US markets and in Indian markets because of this reaction from the Fed?
Well, I think in the Dow you can see a 4 to 5% correction, which could be mirrored all over the world. And if we were also to mirror another 5%, that would bring us down to roughly about 17.5. I think it's a very fair correction. A lot of money is sitting on the side, and there's a lot of support around those levels. Yeah. Anything beyond 5% seems to be, there has to be something coming up more, because the inflation trajectory is on the corrective side. So it isn't that inflation is still going up and, it's a scary thing. We are about 50% of the path, or maybe about 60-65% of the path to corrective modes have been kind of achieved. So I doubt it will be anything sharper than 5 to 6%. And I would basically be a buyer anything below 18,000.
Okay, understood that. Well, Anu, there is slight technical glitch that we are facing. We'll try and fix that and come back to you. Meanwhile, let me take it across to my colleague Tanya Aneja right now, who's actually standing by with a list of all those buzzing stocks in trade today and all of the stocks that have been in focus. Tanya, take it away.
Absolutely, Sakshi. So let's start with IRCTC first only. So shares of IRCTC were down over 6% today after the government announced a stake sale of up to 5% through an OFS, that is offer for sale, at a floor price of 680 rupees per share. So through this OFS route, the government plans to sell a 2.5% stake with the option to sell an extra 2.5%, bringing the total issue size to 4 crore shares or 5% stake. Then we have L&T as well. So L&T shares are also in focus today on the back of order win. So the company's hydrocarbon business, and that is L&T Energy Hydrocarbon, has won 2 orders for its asset management and Advent business verticals. We also have KPI Green Energy. So the shares were trading in the green today, and the company has received an order of 33 megawatt solar power plant under captive power producer segment. So this is a big positive for this stock as well. Then Dilip Bilcon as well, the shares were up to the tune of 6% today. So basically the company executed a contract agreement with the Gujarat Metro Rail Corporation, and the company said that its project cost is around 1,061 crore rupees, and the construction period of this project is around 26 months. So, and the next stock we have on our list is Poonawalla FinCorp as well. So the shares were down to the tune of 4% today, and the company said that it would sell its housing finance unit to TPG Global for 39 billion rupees. So the shares were down on the back of this news. And lastly, we have Sapphire Foods as well. So the shares were up around 5% today after a couple of block deals. So according to some reports, promoter group Sapphire Foods Mauritius and Sagista Reality Advisors and some private equity funds as well, such as WWD Ruby, offloaded some of their stake in this particular company. And the pre-IPO lock-in period ended on 15th of November 2022. Back to you.
All right, thanks a lot, Tanya, for that update as well, and a whole lot of stocks that have been in focus both on the downside and upside right here. But let's quickly take a look at how the market and how the screen is really looking at right now. Sensex is below 62,000. You can clearly see an 878 point of a cut, 1.4% gone there. The Nifty 50 is trying to stabilize around that 18,400 mark as well. 247 points down, cut of 1.3% odd as well. But, just about 10 minutes to go for the markets. We'll just have to keep an eye whether these levels do sustain. 61,800 on the downside for the Sensex and 18,400 for the Nifty 50 as well. So do keep an eye out on how the markets are trading at this point. Look at the, broader markets too. Well, the cuts are severe there as well. So I think the losses are starting to come in and trickle in from the mid-cap space. 1% gone there for the mid-cap 100 index as well. I think we do have Anu back, so we'll just take it across to her. Anu, you were talking about how, you do expect about like maximum of 5 to 6% cut if the downfall starts from here, but not more than that. But just shifting away focus from just the US equities to a more global picture. What one is really seeing is very, very volatile, but sharper recovery days when it really comes to even China and Hong Kong markets. Could that be a bigger trend stepping into 2023?
Trend in 2023, these markets have underperformed grossly the world market, especially China, and because of the lockdown, the economic growth was pretty restrained. Now with them opening up and the economy opening up domestically, their economy will do well. The fact of the matter is that it will be a litmus test as to whether foreign investors are ready to invest into China, because they have doubled down in 22 beginning, 21 end when the stocks were down 40-45%. After that, many of the stocks were down 70%. So a lot of people have burnt their hands there. Given the political situation, I don't know how much money they can attract, but the fact is, from the zero money which has gone into the economy over the last 1 year, something will definitely come. And given their underperformance last year and our relative outperformance, I think they could definitely outperform our markets for at least 6 months or so.
Okay, understood. So looking ahead, do you think that these recessionary fears, the economic slowdown, kind of an environment would be a bigger concern for us at any point? And is that something that we really need to track quite seriously?
So US is a market or economy also where the Fed is pretty quick, and as soon as they see that the slowdown is hurting them, they can reverse and ease the policy very quickly. I think on a personal front, I'm more concerned about the way Europe reacts, and I think that is where the bigger pain points can be. At the same time, we have really not seen how the South American countries as well as the African countries deal with it, and we've usually seen that problems in currency, problems in managing economic deficits both on the domestic and the foreign side is seen there as a problem. So while I think America may kind of by the end of 23 get its act together, I think you will see probably problems emerge on the places where the balance sheet handling is much more weaker. So I would look out for those pockets, and since we are the exporters to a lot of those countries, I think those companies will have to be careful because how demand impacts those countries, just like how we are looking right now at IT, that could be a hidden factor which we may have to worry about 6 months later. On the domestic side, we are getting mixed signals. Some sectors are doing very well, some are kind of not so well. But I think on the balance, I don't think India is a concern.
Okay, looking at the screen now, 950 points gone on the Sensex. 61,735 is what we're looking at. 18,400 gone on the Nifty too. 267 points down. Since you were talking about that decline that you expect, could this be the starting point of that decline, or are we going to see another bout of recovery?
It's very difficult to call out the index on a day-to-day basis, but given that you're breaking 18,400, though even by the averages, you may just about close over that. It's a possibility that it's the correction till about, say, 18,000, 18,150. Which would be, say, from 18,700 would be about 700 Nifty points would roughly be about 4%, not even 4%. So it's not nothing major to be concerned about because Nifty's moved into such high levels and so has Sensex. 900 points or 200 points on the Nifty 275 sounds big, but in percentage term, it's very reasonable.
Okay. Let's talk about the sectors now. The worst performing sector today and perhaps for this entire calendar year has been the IT sector, breaking its 5-year long winning spell in which the Nifty IT index had gone up almost 4 times. The tech stocks are ending the 2022 year with perhaps their worst phase since the year 2008 following the global financial crisis. Your thoughts on this entire space, the kind of decline that we've seen here, is it done for now? Are we going to see any recovery in 2023 or is it still going to be sticky looking at the macro parameters as well?
So if you're looking at the last, 6 months or 8 months, yes, the performance being negative. But if you look into it from just COVID times, I think some of the stocks are still giving you stellar returns, especially the mid cap IT stocks. And I believe that this cycle is going to continue for 6 months to 8 months. You will not see new highs, at least on the large cap tech companies. Mid cap tech, where growth is still 30%, 30 odd percent, which will be there, you can see them recovering, another 8-10%. And even on the large cap, I think bottom is between 5 to 8% down. 5 to 8% down will see a lot of buying. They may not give you substantial returns, but I think a bottom is very close by. So for people who are looking for more than 1 year and these are quality companies, very well managed, cash on the books, no levers, and the fact remains that these will give you a compounding 12-13%. I think these are good to kind of buy at those levels. I think traction may be higher in the mid cap IT, and especially due coming closer to the results, you may see some of them doing well.
Okay, but step into 2023, which are the sectors that you're going to be keeping a keen eye on and you believe that the outperformance could lie in? There's been a consensus buy on banks from the analysts that I've been speaking to all along. Your thoughts? Are you also positive on the banks? And if yes, then which sector, which segment of the banks? Is it the private side or the PSU side? And also apart from this, which are the other sectors that are going to be on top of your radar as well?
So yes, we also are bullish on the banking. Our model portfolio is about 40-42% into banking. We do not cover a lot of the PSU banks, but I think that we've seen a revaluation. Some of them are up 3 times, 4 times in the last 1 year. And, this has been their best performance in 8 years or 9 years. So I think banks definitely is a place to look out. In fact, the entire financial sector, so NBFCs, banks, housing finance companies could probably be good bets. They have already gone up, especially the banks, both private and PSU have kind of gone up very steep. So any correction is welcome to add into it. We personally feel that, anything which is 4 to 5% lower on the bank nifty from here is a good opening point, whether to buy, some of the frontline private banks or even, the PSU ETF, because that kind of plays out the PSU bank ETF plays out all the banks together. Apart from banking, I think we would look out for an infra play on dips. The fact remains that pre-election year 2024 is the election year. Around this budget, there could be some announcements on how to kind of build up the economy. Too early to say, it's still 2 months away. But the fact remains that you will have a certain amount of infrastructure spend. So depending on, some of the larger names can be very positive in the next 10 to 12 months. I would probably look out for those.
Okay. Also, there's this one stock that has moved downwards today and it's catching a lot of eye and attention because of the news flow. I'll just ask your opinion on that. Broadly speaking, what is it that you're making of the OFS news from IRCTC? And at this price, what should be investors doing? Overall, the stock has been extremely volatile. Going forward, what do you expect here? And from the OFS space, what do you make?
See, the point is, caveat, we do not cover IRCTC in our research. So I am not in a capacity to give you a very measured view.
Sure.
However, it is a fact that every time a government stock does well, there is fresh flow which comes in. And that's one of the reasons that these particular stocks, there is supply at every level. And they all, it's become an overhang on every stock where the government is a major shareholder. It's a good company and on the tech side of the government, but I think right now you'll probably see that even at current levels of about 680 odd, you may see a drop down, and it's possible that you can see 640, 650. There, I think from there it becomes a fairly valued, but don't expect exceptional returns as long as it's giving you the normal 10 to 15%. I think that's a fair enough expectation from the stock.
Right. We were just culling out all the government holding in the various PSUs, which clearly are the flavor of the year as well. Would the government try and use the frenzy right now in, say, defense or railway stocks, or also perhaps come up with more OFSs in this space?
Absolutely, because they have a certain disinvestment, commitment to the country, and they have not been able to sell a BPCL or, kind of sell any major unit apart from Air India. So I think OFS into any of these would probably be the norm of the day, and we could see that happening very regularly. I mean, it is but natural as the markets are at the high. It seems a very logical step ahead.
Okay. We're just closing the market right now. I think we are going to be seeing that 928 point cut as far as the Sensex is concerned, 61,799 for now. So definitely a cut right there. We'll keep an eye out on the last closing points too. But stepping into 2023, what would be your advice to these first-time investors who entered the markets in the last 2 to 3 odd years and have seen perhaps for the very first time a slower moving market and a very volatile market throughout 2022? As they move into the next year, what suggestion would you give to them to create a portfolio, a balanced portfolio, and what should be their stock specific and stock picking strategy too?
Well, couple of things. If you're a first-time investor, you should have your asset allocation completely in place, and within the equity portfolio also you should have your sector weightages to benchmark against whether you're doing it against the large caps or the mid caps. I think the fact remains that you have to have a portfolio which is very well invested into in terms of the sectors, and money should be flowing on all dips rather than kind of putting all your money at one go. I think closer to higher levels, one should be willing to book some profits at least for the next 1 year. Where I see a difference which is coming from, say, 2018 onwards is earlier the policy of just fill it and forget, forget it and not look for it at 10 years was a policy which worked very well. And I have done it for clients and seen it work beautifully. From 2018, last 4 years, that policy seems to not work. And it seems to be that even the good stocks, there are ways to enhance your return if you kind of use timing to a certain extent that, at crazy levels, you just kind of book at least 30% of the profits, sit out, use that cash more effectively at lower levels. This was a policy which probably 5, 10 years people thought was, very tactical and people would look down upon it. But the current situation, what we're seeing for the 4 years, and as long as there's going to be volatility in the market, I think being slightly more nimble-footed on your portfolio and being tactical to a certain extent, at least on your portfolio, 20 to 30%, is going to add your IRR returns to the portfolio.
All right. Well, on that note, thank you so much, Anu, for being with us and sharing all these wonderful insights about the markets and how do we see that panning out and the strategy that investors must adopt. Many thanks for tuning in and joining us on this show. And it's been a pleasure, as is always, speaking with you. Hope to catch up very, very soon again in the new year, perhaps, and then see how the markets will pan out from there. Many thanks for joining in. Let's now quickly have a look at how the markets have shut shop today at the closing action right there on your screens. A deep cut in the red is what you can see, both the benchmarks. Sensex at 61,799, just that 1 point away or below that 61,800 mark. 878 points gone there, a 1.4% cut. The Nifty down at 18,414 managed to just pull up towards the last few seconds when we saw that pull up above that 18,400 mark. 245 points gone there. Another cut of 1.3%. The mid cap, let's look at that one. That saw a sharper cut towards the last 15-20 minutes odd. The Nifty mid cap 100 index was also down by over 1%. So there is what you can see. But just that last point, if you can see, there was slight recovery, uptick that we saw from the lowest point of the day as well. Among the sectors, you're seeing all the sectors down in the red today. The maximum beating being seen on the IT space, 2.2% down. The media stocks down as well, 2.2%. Metals are seeing a cut of 1.5%. 2% gone there for the PSU banks as well. So a sharper cut towards the end of the day for the PSU banking space too. If you look at the intraday chart, you will be able to find out for the PSU banks that all of this cut came in just in the last half an hour, last 15 minutes of trade. So you can see it's ended almost at the day's low point as well. Apart from this, it's 1.5% cut for the realty space as well. The private banks, financial services down in the red, almost a % cut for the FMCG basket. The farmers slightly lower, about 0.6% gone there for that one too. The market breadth clearly favoring the declines in today's trading session. Overall speaking, maximum of the stocks ended in the red as far as the Nifty is concerned. In terms of the gainers and the losers, let's look at the losing action first. Sharp cut coming in on Tech Mahindra. That was the top loser in trade today. 3.8% gone for that one. Sharp volumes as well. Infosys, sharper volumes, 2.5% cut for that one too. Titan, another stock that got beaten today. Eicher Motors, HDFC and HDFC Bank. So the both twins heavyweights that saw sharper cuts towards the end of the session. Talk about the gainers, however, there were some bright spots and you did see Britannia, Hero MotoCorp, NTPC, SBI Life and BPCL, all of these that managed to pull up some gains. It's very minor gains just above the flat line, but still holding up onto those gains towards the end of the session as well. Look at the volatility index. Of course, it's the day when we have seen the options expiry as well and the weekly options expiry. We've seen a 6.8% uptick, 13.7 is the level at which the India VIX has really moved up. So, keep an eye out on that. We'll have a look at how the markets are really trading globally. That is the US markets overnight. If they see a sharper cut, we may as well see deeper cuts tomorrow. But in case there is any sign of a recovery right there, we could also look at some kind of an uptick for that one. But largely, as our guests pointed out, the rate hikes were on the expected lines, but the hawkish commentary is definitely what has really spooked the markets as of now. Many thanks for joining us on this special edition, but do stay tuned on to Business Today TV for a whole lot more coverage from the world of business and from stock markets too. Don't forget to subscribe to this channel and do stay connected with us through all our social media platforms, Facebook, Twitter, LinkedIn and Instagram. You can constantly engage with us there. Many thanks for joining us on this special edition.
Huge relief coming in there for consumers with the wholesale inflation falling to a 21-month